Hey guys, welcome to the ValueHunt podcast. And today I'm so excited to be here with David from Kingdom Capital. And he's an expert in value investing. I got some ideas from him, so I must give him roses for that. Maybe we'll dive into some of his ideas in this chat interview, whatever you want to call it. But let's first hear what David has to say before we jump right into the questions.
Sure thing. Thanks for having me on, David. And I don't know about an expert per se, but I certainly have a lot of fun investing in stocks and digging into ideas. So excited to swap some today here.
Perfect. Sounds good. I'm excited to start the conversation and really learn more about you and your investment style and let the audience know what you're doing. So why don't we jump right into the first question, which I always ask to my guests, and the question is, who is David? This is such a simple but broad question, so let's see what you answer.
Thanks. So I been running this fund here for almost 3 years now. Launched at the beginning of 2022. I live in Northern Virginia. I've got three young kids that keep me pretty busy. One of the reasons I felt strongly about kind of going out on my own was I wanted to be my own boss and have more flexibility to be with my family. So I get to do that more now than my old desk job. So I appreciate that. I like being my own boss. I can't imagine going back to a day job at this point. That's kind of a little bit more about, I spend my time looking at stocks. I really enjoy actually reading financials and trying to figure these things out. So I'm doing what I love in terms of work. And I knew this is what I wanted to do 3 years in. I'm really enjoying it. So it's been a lot of fun for me, and hope to keep doing this for a long time.
Yeah, hope so too, because I think you're providing a lot of value to the people that follow you and so on, and obviously to your clients too. Actually, I wanted to ask you maybe a more of a personal question because you mentioned your kids, and for someone that really wants to go serious about investing and let's say build a career in that industry, how possible is it to be, let's say, a present father like you are, or I imagine you are? I don't really know, but I'm assuming. But anyways, how do you manage being a present father while still doing a lot of work and research and running a fund full time, basically?
No, that's a great question. Honestly, it's going to depend by the person. I know lots of people in this industry that have figured it out. I guess part of it is, what we're doing. You can spend an infinite amount of time researching stocks. There's really no limit to how far into the weeds you can get on something. So I guess part of it for me is just understanding that I've got to kind of set boundaries of, hey, there's a point during the day where I'm just going to close the computer and, go spend time with the family. Doesn't mean that stuff doesn't occasionally get in the way of my plans, but again, one of the reasons I wanted to go out on my own was so that I would have more control over my schedule. And if you're going to research a stock, you can kind of decide when you want to do that. It's not doesn't have to happen at a fixed time every day. I think that's one of the big things for me is just kind of trying to draw boundaries around what's family time and when I'm going to be present, and just making sure that I have the flexibility now that I can be there for my family and my kids in a way that I guess when I had someone else tell me what I had to do and when I had to be places, I didn't have that flexibility. So I do that more now. I feel like it's allowed me to, be able to get time away more, be more focused. And I think up to this point, it's allowed me to be much more present than I would have been able to otherwise. And I want to keep doing that.
That's really interesting, and I believe that's a priority for a lot of people. So learning from your experience and other people's experience is really valuable in this field. I would like to ask you if you could guide us through let's say, the path until becoming independent and being your own boss and running the fund? I know you started the fund, let's say, in a not so good time in the market, but you still managed to survive, which is actually the hardest thing for funds to do, because most of them fail, I don't know, 5 years or three, whatever. So I would like to ask you if you could guide us through that path, that you followed to get where you are now.
Sure. Yeah. So with anything, it's some of it is luck, some of it's skill, and some of it you're never quite sure. So I think one thing that we were particularly fortunate about when we launched, we had a very heavy allocation to the energy sector in January of 2022, and our thesis wasn't, hey, Russia's going to invade Ukraine and energy prices are going to go through the roof. But
Right.
that's what happened the next month. So um, it
That's
worked out
pretty
really
awesome.
well for our fund. It wasn't what we expected, and obviously wasn't due to some amazing thing happening that we were excited about. But we were watching things develop, and like, wow, this is taking the upside case on a lot of our commodity price targets was going a lot higher, and yeah, we were in the right place at that moment. So like I look back at that and think, hey, we could have been excited about other stocks going in, and we think our theses were solid, and was open to an upside surprise. Those do happen. But yeah, you don't always know when things like that are going to happen, and they can be good and they can be bad. I think there's I think a negative example of this that I'm reminded of is the Q-Rate retail distribution center fire that I think happened a month or two before we launched. And I wasn't involved with it then. It's mostly just a stock I've watched, but you know, right before the holiday season, suddenly your main distribution center burns down and you're not able to fill orders, and it's been a mess. They've had a lot of insurance claims. They've worked through things, but it permanently damaged the business in a way that the day before nobody would have told you. Yeah, one of my main concerns here is their distribution center burns down, but that's what happened. So I am reminded that there is an element of randomness and good and bad luck here when you're trying to identify investments. And so we try to, as best we can, isolate those risks. We try to identify what can go right and go wrong, but you just never quite know. There's things can happen geopolitically, economically. Um, Individual people can have crazy, outcomes one way or the other, just with stuff that happens at a specific business. And you can look back on it and feel like you were a genius, but oftentimes you were just in the right place at the right time when a good surprise happened. And if you were well prepared and bought stuff that had was well set up for good surprises, great. But yeah, it's a there's an element of randomness here, and we're thankful for the parts that have gone our way, and we're glad we've been able to minimize some of the things that haven't.
That's pretty cool. And why don't you guide us to the steps before actually launching? Because obviously you've told us the story of how it went so well and how you're thriving. But what comes before that? What did you
Yeah,
do before? What's your background? And yeah, how did you manage to get to the point where you can launch a fund?
sure. Well, I was working in mergers and acquisitions consulting prior to this, and so I was looking at a lot of private equity deals, and so that was good learning ground for me in identifying, hey, these are some of the best guys in the business. What are they looking at when they value a business? What are when they're doing quality of earnings adjustments and they're trying to determine where opportunities are. What gets them excited. That really helped me, at least on the early side, learn about how to invest, and it made me realize that I should probably be doing this for myself. So obviously, it's a little tough trying to trade a personal account when you're working in that business, because you've got a lot of restrictions on not being able to trade stuff related to clients and anything you've looked at. And so I did have my hands somewhat tied, but fortunately, there's tens of thousands of stocks, and I was not working on tens of thousands of deals. So was
Right.
able to find some good opportunities there. Was able to learn more about kind of what worked and what didn't for me personally. and I started publishing ideas. I used Seeking Alpha was one of the platforms I was publishing on early. I think it gets sometimes gets knocked for the quality ideas not always being the best, but is a good learning platform, and getting feedback from people on how I could improve was a good way for me to learn. And I appreciated the good feedback I got, and the investors I met on the platform who thought similar to me, and we were able to share ideas and help me grow. And it gave me a public record of, hey, here's things I've liked, here's how they've worked out, and here's what I learned from the experience. And I think the more honestly I could do that, the better it prepared me to be ready to actually go and launch a fund. Because I started having a record that I could point to and say, hey, here's how some of my ideas have worked out and why. Um, so yeah, after that had been going well for a while, and I was trading my ideas and building a track record. I got to the point where I felt like I had the ability to go out and try and do this, and I had friends and family and who believed in me enough to be willing to trust me to manage some capital if we went and launched a fund. So that was kind of the early catalyst, was just hitting that escape velocity of the results were good enough, the position was solid enough that I thought, hey, we could go do this, and I've got a little bit of runway to make this work. So then I started talking to other guys that had launched funds that I had met over the years, and hearing how they had done things, and gave me some good direction on what I did and didn't like from some of their different structures.
Right. That's pretty cool. And yeah, I really think there's a big power given by the internet on building a track record, and I don't know, exposing yourself to other people and feedback through Seeking Alpha, Substack, Twitter, whatever platform you really use. So what advice would you give to people that are trying to build a name for themselves in this industry, and they don't necessarily have the track record to back it up, but they are trying to build it slowly as you did?
Yeah.
What would be the main advice for those people?
Yeah. One is definitely to actually do it. I've seen guys who trade paper accounts, and I think,
Yeah.
obviously some people you might launch an account and it's, you're not trading a very large amount of money, or maybe you can do almost nothing. But I imagine if you have the time to be writing about investing, you probably have some level of disposable income. And yeah, put that money in the market and start feeling it when your ideas work and when they don't. I think losing money on stocks is a great learning experience. It works a lot better than getting an idea wrong on paper that doesn't actually hurt you personally. So some of my most painful lessons will be ideas I got wrong and lost money on, and I don't think you can replicate that in a better way as an investor. So obviously, you don't want to pay too much tuition at the school of bad ideas, but I think having an account out there and starting to write up ideas and starting to try and put it out there, getting your thesis out is important because it allows you to go back and read it and understand if you actually got the idea right or if you just got lucky. Kind of like I was saying earlier, I have some thoughts on energy, and I feel like I was in the right place, and I feel like my thesis was right, but I still benefited from things that I wasn't expecting. And so I think it's important to have those thoughts on paper and to put them out there so that you can go back and be honest with yourself about what you saw coming and what you didn't, and understanding kind of the risks and the rewards that were there versus what you said. Because it's not usually, even when you made money, there's usually things that didn't go the way you expected, and it's good to
Yeah.
understand those over time. So I think having the track record and running those things up is very important. And I tell people that the reason I like to share ideas publicly is I like finding out holes in my thesis before I lose money.
Hmm.
And I think that's something I didn't grasp as much when I started. Like I felt like I was trying to put pitches out there for, well, people will see how smart I am, or, I'll be able to use this to build a track record. Um, I really value now when I get feedback from people on issues that I have either missed or misunderstood. It has saved me a lot of money being able to get negative feedback early as opposed to getting it after the idea doesn't pan out. So again, I think there's a lot of value in being able to be humble and accept pushback on your ideas. And sometimes the pushback is meaningless, and allowed people to talk me out of stuff, and I look back and realize that I shouldn't have. So it does go both ways, but I do think that there can be a lot of value in getting feedback, especially early on as an investor, and that if you are willing to receive that and test it, it can also help you from making some really painful financial mistakes.
Yeah, for sure. Like honest feedback is the one of the hardest things to get, especially from people that are close to you. So I guess in the internet there's less of a barrier to that. For example, with my YouTube, I get a lot of valuable feedback on how to improve the quality of my interviews and videos and so on. So it also works for investing, and that's the beautiful thing about this network that has been built over the past 20 years or so. Now, switching a bit topics, I'm
Yeah.
really curious to figure out for myself what's the utility of money. And since money is the bread and butter of investing, because obviously to invest you need capital, I would like to know what's your take on what's the utility for money in your case, and how do you think about it in general?
Wow, that's a good question. Not one I was expecting today. Um, yeah. Utility of money. Well, it's what means of exchange. It's allows society to function instead of us having to be forced to barter goods and services for each other. So, I think yeah, at a basic level, it's a very useful object. I think that can be used for good and for bad. I think one of one of the hopes I had with founding Kingdom Capital was that I was primarily investing money for friends and family who I respect and feel like have generally a good grasp on how to allocate their money in such a way as to bless other people, and whether it's their kids or others around them. And so my goal is to help them better do that. And so that's kind of, as I think about money, I see it, using money as an opportunity to for good, and to positively impact the people that are in my life. So I think that at least personally, my Christian faith is the foundation of that, and I seek to be generous with the money that I have, and I think that it allows much good to happen if used correctly. And so, as I'm thinking about acquiring capital and deploying it, that's kind of the heart of what I'm going for, is to do good with it and be a good steward of it. So I think it's useful, and I hope that Kingdom Capital is able to put money in the hands of people who can use it well.
Yeah, deep question, but good answer. Congratulations.
Thanks.
um, yeah, now maybe an easier thing or something that you are more familiar to is actually your investment philosophy. So you've talked a bit about Kingdom Capital and being invested in energy, but what's the go to company that you look for when doing research?
Yeah, I mean, so I guess the one of the first investments we made was an energy company that I still think is kind of the gold standard of situations we want to get involved in. And this isn't for everybody, but it was a unit corporation. It had a lot of things we liked. It had just come out of bankruptcy and was trading on the pink sheets. So you had a company that had just been through the bankruptcy process. It cleansed a lot of their balance sheet. They were better capitalized. Their industry, generally coming out of bankruptcy, industry is kind of in a trial and looking up again. Very little analyst coverage, generating a lot of cash, and most importantly, had a very clear mandate to return capital. And so we like cheap, obscure, and returning capital more than in pretty much any other setup that we've found. So those are situations we want to get involved in. We really like buying something where we see the ability for free cash flow generation to be substantial and immediate. We feel like the further into the future we go, trying to project things, the less accurate we are in a hurry. Some people are very good at thinking that way and thinking 10 years out and seeing where things are headed. I don't think that's my gift. I think I'm good at seeing things that are a lot closer. And so that's what I try to focus on. So I look at cash flow generation, I look at a lot of it, and I look for it in the immediate future. Um, and those are what really attract me. I like hard assets that have value, that can be more easily compared. Again, this is I feel like that's the easier stuff, but I like easy. I don't want to make this game any harder than it already is. So the more I can get comfortable with something that has hard assets, that's generating a lot of cash, and is taking that cash and returning it to shareholders, um, that is going to jump to the top of our list in terms of ideas.
Right. Yeah, I must thank you for that idea too, because I got invested, maybe not at the same cost basis as you were, but yeah, it returned pretty nicely. And I actually did a video on it and posted a thesis on various platforms.
Yeah, I
So
think that's the
yeah,
first time we talked about it.
sorry.
I think that was the first time we talked about it, was after your video. It was well done.
Yeah, exactly. Yes, I think that's how we met actually. So, yeah, a pretty interesting opportunity. I would be curious actually to know, since you touched on that name, and I believe you sold. I would like to know what was the rationale behind selling, and also maybe if you had any interaction with management or anything like that, or you just keep the research on the public, let's say,
Yeah.
information that's out there.
No, great question. I think that I mean, you're hitting a great question, which is, the when to sell on an idea.
Yeah.
I think on unit specifically, it was pretty straightforward, and it was the stock approached our estimate of fair value. Um,
Hmm.
so it wasn't that we thought unit was overpriced or was no longer a good investment. It just was approaching, for the first time since we had owned it, close to what we thought it was worth. Um, and there's always some noise with that, but the closer you get to fair value, the less excited you are about owning that over something else. And so in Unit's case, they came out in December and declared a pretty massive special dividend, and the market loved it. Our understanding and from our conversations with management and reading what they had been putting out for 2 years was that they were going to return capital. They had been returning capital. We expected them to return capital, and they eventually did. But that apparently was not expected by the market, given how much the stock went up on that news.
Right.
And um, I think the one specific thing that happened with that deal and that made us most concerned about staying involved at that point was that they had sold some land that was producing at the time, with that special dividend, and were paying that out as a dividend. And so while a lot of the cash they had just been earned from operations over the last few years, this was kind of the most material, selling of production and immediately distributing that, where you are immediately decreasing the value of the remaining business. There was some uncertainty around what exactly they had sold at that point. They didn't give a lot of detail when they first announced that. And so our concern was, well, there is an opportunity now for this to be a more negative surprise. And we could find out that they've sold more production than we thought. And that dividend's already out the door. So the value of the company has decreased from before that dividend announcement, because they actually paid part of it out in cash.
Right.
Um, so I would say that was the biggest concern at that point. I mean, what they sold, I think they got a good price for, and they're still earning good cash flow from what they have left. But their earnings have materially stepped down this year, compared to what they were prior to that point. And the mark they got on those assets also suggested they were pretty fairly valued with what they had left. So especially in Unit's case, it was seeing something where the market was finally giving it more credit, and the situation was, in a sense, getting worse because they were selling off earning assets, and so the remaining company would be less valuable. So when the price is going up and the value is going down, that's the moment where we're probably most likely to want to sell. And
Maybe now you'll understand why I said it was a mistake before we started recording. And I actually did the opposite from what you did. I saw oh, after the dividend was distributed, the stock declined like 50% or something.
Yeah,
And I said like, oh, it's getting cheaper. So I just bought without really understanding what they had sold or anything like that. So yeah, I couldn't see what you saw, and that's why I call it a mistake, even though yeah, basically I didn't lose any upside because the price has stayed pretty much stable.
yeah, it's been solid.
Um, and I even got more dividends after that because obviously I had more shares. But yeah, it was a mistake because I acted upon market movement and not really, let's say, a profound understanding of the event itself. But anyways, it was a good learning opportunity, and as you said before, without paying too big of a tuition, which is always ideal. And maybe I asked a two-part question, so my bad on that. But
No, you're
have
good.
you? Did you talk with management before, and how did you got comfortable with their allocation strategy? Since, from what I understand, they don't have too much information in the public domain about the CEO or the fund manager that is running the company, basically.
Sure. Yeah, I think that was one of the other items that yeah we were able to get comfortable from talking to them. And Phil, the CEO, had been his fund had been a large holder of the bonds going into the bankruptcy process, and then got a large chunk of the equity as a result of that. Um, we thought very highly of him. We thought he was seeking to do right. He was an Oklahoma City guy, or Tulsa guy. Sorry, um, and really cared about that community. So his fund was based there. The company was based there. He knew all the people involved, and he was trying to run it in such a way as to do right by his employees and by his investors, and by the the different stakeholders in the company. Um, he's not an oil man, so I think that was certainly a concern some people had, is that he's a fund manager, he's not a wildcatter. But I think he understood pretty well, like, look, I own some assets that generate a lot of cash flow, and I'm going to allocate that well, and I think everybody will come out ahead, and he's done that. So we felt like he had, I guess, the right alignment with the community and with the company to want to do the right thing. And we feel a lot better about that than somebody who may feel like they can make a quick buck at the expense of the people around them or their shareholders. And I think that that in particular got us really comfortable. And yeah, just they were a very conservative outfit, which means you usually don't make as much money on the upside, but you really. I've gotten more and more attracted to investing in companies where I feel like my downside is rock solid, and I felt like this team was making sure that they're coming out of here as bondholders, where you don't want to realize losses on credit investments. And so there's a lot of mindset there about how can we make sure our downside is solid, and that's what they were doing. They
Right.
were just throwing cash off left and right. And yeah, if they had not sold any assets and run this thing full bore, and when gas got to $9, I'm sure your upside would have been even higher. But they were being thoughtful about it and managing it well. They hedged a lot of energy prices near the top when few other companies did. So I felt really good about a lot of the ways that they were good stewards of shareholders and looking out for them and trying to make sure that they ensured a good return, and not just trying to maximize upside without any thought of what could go wrong. So yeah,
Yeah.
that was our main takeaways. We really liked their management team.
For sure, that's really cool. And how do you feel like about the future prospects? Do you think the management will sell, liquidate, or what will they do? Because at the end of the day, they basically completed their goal of returning most of the cash to shareholders. And what comes next?
Yeah, I mean, they still got some valuable rigs that are throwing off a lot of cash flow. They've still got a lot of gas and oil production that's out there. I mean, their costs have come down. They've right sized the business. I think they're going to keep running it and generating cash. And if somebody comes along who's willing to pay them what they view as fair value for what they have, I think they'll probably hit the bid and move on. It's always felt like it kind of wasn't really a natural shareholder base for this thing, given all the credit investors, but they've done a good job running it carefully and generating a lot of cash, and they're still doing that. So I imagine that will continue.
Yeah, that's awesome because I still own a bit, but this time before making a decision, I'll try to really look into what's happening and not just get excited. But anyways, thank you for your takeaways on that one.
Yeah.
I would actually try, since I already shared a mistake. I don't want to feel like I'm the only one here who makes mistakes. And why don't you share some of your most valuable mistakes in the past that have significantly changed your approach to investing or that have improved your investment style?
Yeah. So it's funny. I think I talked about how energy really saved the day in early 2022 for us. Um, I told people going into when we launched, I said, I think our largest position is going to be Dole Foods, and that that's probably going to be a large determining factor in how we do. And I'm very thankful that was not the case, because we bought Dole after launching and wrote it down about 50% in 6 months. So
Wow.
was a pretty large headline loss to take in a tough market. A lot of things went down 50% in 6 months in that window. But we were wrong about a couple key items with that business that slowly became apparent. And while it's since recovered and done a lot better than it did in that window, I think uh, one key thing I learned, they had a large recall that happened right at the beginning of that year. The impact was somewhat uncertain, and I think my ability to forecast just how bad an event can be is not very good. And so looking back, I knew it wasn't good. I was calculating potential downsides, and generally my estimates were not as bad as what happened. So I learned that uncertainty in the market gets punished, and as that continued to drag out and be an overhang on the stock, that was one of the key reasons it was selling off. I also had overestimated the company's ability to generate cash, and that was yeah, there's a lot of EBITDA here, but the actual conversion to free cash flow was a lot lower than I expected. And I've been through the financials, I've been through the different puts and takes, and I just overshot my number on what they could do in a normalized environment. Um, and that's where people will often say, rule of thumb, if you're looking at an EBITDA bridge that's got a number and about 25 adjustments and then an adjusted number, that's you should probably steer clear. Not always the case. In this case, the numbers were pretty similar, but there were just so many things happening in that business. Ag is tough. These guys are good operators. I think they're running it well. They were in a tough inflationary environment where there was just currencies and fuel prices and container board were flying all over the place, and they managed through it well. But I underestimated how hard that was going to be and how hard it would be to generate cash in that environment. I was not invested in somebody with a tremendous amount of pricing power and control over their circumstances, and they managed through it well. But that didn't stop it from trading down quite a bit from my expectations. Um, so I got a lot of things wrong in that one. And again, fortunately, the stock price has come back up, but I got in too early and was too optimistic for the price I paid. So that's certainly probably my first and most costly mistake with the fund. And similar but differently, you may remember a few years ago there was a popular stock on Twitter that was Gettikers. They merged with another appliance retailer called Appliances Connection. The thing was flying around for a little while, had a lot of special situations and people getting involved. I did a good job fading that situation initially, and eventually it got low enough that I decided to bite after just about everyone else had burnt out on it, and I felt like I had navigated that well. And I did that straight into them putting out a vague press release that there were some accounting irregularities they needed to look into, and the stock got chopped in half the next day.
Wow.
And even after that event, I had multiple opportunities to reduce my position and to get out. And the longer I waited and tried to figure out what was going on, the worse things got. And so there's an axiom about if you're going to panic, panic first. And I certainly, looking back, wish I had done that, because there were some concerns with the company. And while I feel like I was doing the best with the information I had, I just didn't have all the information. I didn't know what I didn't know, and uncertainty gets punished by the market. And you are often just best taking a loss and moving on rather than trying to will a loser back to your initial investment price or whatever you think the new fair value is. Um, so both of those were situations where I wish I had got out sooner and done a better job of understanding my downside. Um, but again, fortunately, we've been able to manage through those, and we're always going to have negative surprises in the portfolio. But those two both taught me the value of understanding downside and especially of good management. Dole's management has done a great job, and so even though I got some stuff wrong, they have managed through it well and been slowly delivering on the initial promise that investors expected there. The management situation at Appliances Connection was not as good, and I regret trusting them with any capital.
That's really interesting. And since we got back to the topic of management, I would be curious to know what are your, let's say, strategies for getting in touch with management, because it's not always easy to get hold of them because they are busy and stuff like that. So, um, how often do you get in touch with management of the companies you invest in, and what strategies do you use to reach out to them and actually get the opportunity to talk about the
Sure.
business itself?
So it's really, I would say it's company specific. There's some companies where I don't think that there's any value that would come from me speaking to the management team beyond what
Mm.
I can glean about them publicly. And that's both good and bad. Sometimes I'll look at a company and think there's no way I'm getting comfortable with this management team, so I shouldn't even bother giving them a call. And there's others where I'll look at it and think, these guys, it's like if you're trying to look up like, oh, is Tim Cook somebody I should really invest money with at Apple? It's like, well, I don't really need a phone call with him to figure that out. I can see his track record in the public markets and figure it out for myself.
Right.
So in small caps, it's usually not that simple. But there are some guys who've been around for a while and they've kind of told you who they are from running other companies and putting a track record out there. So much like other fund managers, sometimes it's best just to trust that and not get on the phone with them and allow them to taint your perspective beyond that. It's caused me to miss ideas, both good and bad. But yeah, I think it really depends. There's some companies where I look at it and think I have very specific things that I would be greatly aided understanding if they could walk me through this. Why they did something that I don't understand, what they're hoping to accomplish. If a company says, "Hey, we're looking to sell a bunch of assets," hearing directly from them what they want to do with the capital be a lot better than implicitly trusting that they're going to do the right thing. I've had some companies where hearing them talk about capital allocation was enough to keep me far, far away from ever giving them any money, and I might have been tempted to otherwise. And there's other guys where we get off on the phone from talking to them, and it's like, wow, those guys inspire confidence and sound like people that we would want to give money to. And usually there's a track record to go along with that says they're pretty good at it. So I think those are the things where if you have specific actionable ideas, getting them on the phone is helpful. I think for me personally, I've had a lot more success getting guys on the phone now that I have a fund, and
Yeah,
David from
obviously.
Kingdom Capital Advisors instead of David from Gmail gets a lot more. So I think I almost got to the point with before I launched where if someone responded to me, it was probably a red flag that they were too available to speak to anybody that reached out. So take that for what it's worth.
Yeah, yeah, I
Um,
guess.
so sometimes, it's like, oh, you've published an article on the company. We've seen you around here. Small companies, there's not a whole lot of media. So, if you're writing about them on Seeking Alpha, they often have seen your work or, if you're Substack or whatever. And that's its own issue. Um, but there is some ways where that can still work out. But yeah, by and large, it's easier to, go to a conference now and like, hey, I run a fund. And, they usually don't ask you up front, well, what's your AUM? How long have you been running it? So
Yeah,
it,
yeah.
it
Actually,
makes it easier.
I have a funny story on that one. I'm sorry if this is off topic, but I have
No,
to
go
tell
for it.
it, which is actually I went to Germany and met this German investor who invests in junior mining companies. So basically, speculation is not really investing, and he got so popular on Twitter that the CEOs of these supposedly mining companies actually fight in the tweets and say, "Oh, this company is bullshit," blah blah blah, and they try to promote their company. So yeah, it's basically just a funny story. And to your point, that if management is too available for chatting with, I don't know, random people on Twitter or anything like that, it's probably a red flag and not a good idea to put money at work in their business, or trust them with your money. So yeah, it's just really funny how different the spectrum is. There's, like, for example, this company Dino Polska, where the management has never given any interview, has not even gone to the listing at the stock exchange. So you have that, and then you have CEOs discussing on Twitter and trying to promote their business. So yeah, it's just funny for me.
Yeah,
But anyways, this is what we have. So yeah.
it's always fun.
Um, yeah, actually, it is pretty funny. But switching a bit topics and getting into more serious stuff again, investing is all about, let's say, managing your own emotions and not panicking when things go wrong, and actually staying rational. So, what are your main strategies for, let's say, preventing yourself from acting irrationally, and really being in a stable emotional state where you can actually take clear decisions?
Yeah, it's a great question. I like to quote Annie Duke on this one. She has a book where she talks about kill criteria, and
Yeah,
about how in poker, when she gets dealt a hand, she will, look at it and essentially just to put probabilities around different outcomes and just pre-commit to folding or betting more depending on where things are going, and just have a mental idea of, hey, if this card gets flipped, here's what I'm going to do. If that one gets flipped, here's what I'm going to do. um, and how, she's always reading the room and assessing probabilities and doing that in advance, so that once something happens, all she has to do is execute a plan as opposed to reacting in the moment. And
right.
I think that concept in the market really does translate well, and that, you don't always know what the range of possible outcomes are. So, like I was kind of saying earlier, like there's some stuff that might come up unexpectedly where, depending on what the issue is, maybe you want to stick around and wait it out. Maybe, but I think often, unexpected things happen, and often the best answer is just get out and wait to see,
Right.
the scope of what you're dealing with. And so having that criteria of, hey, something unexpected is happening, and rather than trying to react to it emotionally, our thesis is now in doubt because we had an expectation and that's no longer what's happening. And so we're going to step back and we're going to let and see what happens. And, people approach this differently. I don't think there's a right answer. And, sometimes bad things are happening and you look at it and you go, yes, but like we've thought about this. Sometimes they're happening and you haven't. So I think it's best to just have a good framework for, if management does this, we sell. If management does that, we buy more. Or if the earnings do what we expected, we stay in. If they unexpectedly disappoint for the fourth time in a row, we are out. Um, and so, ideally, you put those markers out there and you're ready for them, so that in the moment you don't have to react to stuff that's happening when your emotions are higher. Um, so that's been, I think, the most helpful thing for me is just to have a model of, I know what would need to happen for me to buy or sell this company, and I just need to wait for that to happen. rather than react to something in the moment. And things happen in the moment. I've got a couple hundred companies that I look at fairly regularly, and I'm waiting for some things to happen on some of them for me to buy, and you know I don't expect those things to occur, and I might not end up being able to get involved when they do if the stock price goes up too much. But I've got an idea of what they're worth, and I've got an idea of what they're going to do, and I just wait. And I think the more you can do that and not have to react in the moment, the less likely you are to make decisions you regret down the road. Because you'll still make wrong decisions, but you can look back and say, I followed my process, and I got something wrong, but at least I did the best with what I had.
Right, that's actually a great strategy, and I had heard about the kill criterion from Jake Taylor. Maybe he got it from that book that you mentioned. Um, and maybe I have a more technical question because obviously once you establish a process, an investment research process and checklist and so on, you end up starting to get a lot of little steps and complexity in your own investment process. And so how do you keep track of all of it? Do you write down memos for yourself on, I don't know, on Google Sheets or whatever, or you write it on paper? How do you prefer to keep track of all your ideas and your thoughts on a given business? How do you keep folders on that one, on those
Yeah,
businesses?
no, I've got a folder out there that's got a bunch of different ticker names, and got has research and thoughts on them, and some of those are things we've owned and sold, some we never bought, some we still own. Just try to, when there's something worth cataloging, try to put it down on paper and remember it. I think one process that we kind of enjoy doing at Kingdom Capital is that I don't know kind of how this looks for other people, but essentially is just going through our book and thinking about what our upside and downside cases are, and kind of just like trying to force rank our ideas, stuff that we own, stuff that we don't, and just trying to think through like, hey, have we let something drift to the point where we probably are incorrectly weighted for where we see the situation going. Like our upside's gotten better and we haven't taken the position up, or our upside's gotten worse and we haven't reduced it. Um, just trying to use that as a sanity check. It's not a very technical, way of doing things, but I think Mike and I really have appreciated just being able to think about like, hey, is there anything that just feels out of whack in the portfolio right now, and why? And running through that occasionally together to just kind of sense check things, because we got all this research, we got all these thoughts, we have all our emotions, and sometimes it's good to just kind of look at the numbers, think about where they are, think about what we're expecting, and just make sure. I think like sometimes I'll ask him, like, hey, if we had to get rid of one stock right now, what would it be? Or he'll say something, and it's a good way to think through like what are your emotions saying versus what has been happening in the market, and why. Why is it you want to get rid of that? Because it can help you pinpoint feelings before things get worse. Like, hey, well, they told us this, it hasn't really panned out that way, so it's starting to make me think we shouldn't trust the team, or they were told the market they were going to do this in the second quarter, and that's not where things landed. So do we still really think that the earnings are going the way we thought? Whatever. But yeah, I think in addition to having all these tables and thoughts down there, it can be good to just try and pinpoint where your emotions are, and before you've done things emotionally with a stock.
Interesting. That's pretty awesome because sometimes we we talk too much about the big questions, but then we actually don't talk about the small details that really make a difference. And if you're not really organized in your investment process, then writing down your thoughts or whatever, it's not really helpful because you never end up revisiting that or whatever. So yeah, it's pretty helpful. You also touched on the point of position weight in your portfolio and stuff. So why don't you guide us through how you think about position sizing and actually weighing your positions so that yeah, it makes sense for your strategy?
I think this is probably the most important and least covered thing from my limited experience as an investor. Um, People have very different ways of approaching this, and a lot of it is driven by kind of what you're trying to accomplish. There's guys out there that will say, "Hey, I don't go above 2% in any stock," and so I'm running a portfolio with 50 to 100 names. Um, you know, and their goal is to beat an index, but it's probably not by much, and it's probably a fairly diversified, lower risk. You're doing a lot of work, but you can't go as deep on 100 different stocks. So you're going to get index like performance. Um,
Right.
so you have processes like that. You have guys that are out there, just shelling, large chunks of their portfolio into one stock at a time. A lot of those PA guys you'll see on Twitter that like, oh yeah, I'm up to 60% in this thing, and it's like, all right, well that, or Druckenmiller does, he's 200% long the euro versus, there's all these stories out there of survivors doing stuff like that. Um, but you have to think like, all right, practically, if I'm managing other people's money, like I've got to have risk management in place. And going 200% long something is not something we are ever going to do. Maybe that works for you, and maybe if you're early in your career, you just want to try it. You can find out, a good or bad lesson depending on how that goes.
Yeah, exactly.
um, but yeah, I think for us personally, we feel like there's a sweet spot that's kind of in the around the 20 positions in the portfolio at a time, with around five of those making up, give or take, half of the portfolio. I think the sizing in there, like I was saying earlier, we really favor stocks that are, a larger position is going to usually correspond to what we think is a much more protected downside. Um, so, our highest upside stock is usually not our highest weighted position. Usually, our best upside stocks are you know have a lot of risk associated with them. So it's like, hey, we think this could go up 5x or zero. That's not going to be our biggest position because we don't want to torch a lot of capital on that in the downside scenario, likely or unlikely as that may be. So we are thinking about preservation of capital. We're thinking about liquidity. I mean, we don't want to go 25% in something that is going to take us 3 months to get out of. If it's
Yeah,
very
exactly.
thinly traded or doesn't trade on given days. That's not the kind of liquidity our clients are looking for. If it's just your personal account and you don't care and you want to get huge and something like that, get trapped. That's your right. But when you have clients and when money is coming in and out, you got to think about how liquid do we need stuff to be, and how big can we go in something that we can't trade as freely as we would like. Um, so those are certainly considerations. I mean, there's stuff that I have where if I could, I would probably buy more of it, but I can't given liquidity without feeling like I'm too concentrated. So those are certainly things that I'm looking at. But it's a tough game. I think sizing is one thing I want to continue learning on as much as possible.
Right. Yeah, for sure. That's really interesting for me, and I've been researching about this topic for a while now, and yeah, you can't really find too much on it. And there's a couple of videos from Monish Pabrai and stuff like that, but you don't see too much covered in investment books or the classics, so to speak. I think it boils down to really personal preference and your own, let's say, investment style. But obviously, I would say there's a rational range where it doesn't really make any sense to hold more stocks than that, because otherwise, just buy the S&P 500 or something like that, and you'll get maybe better returns without any effort. So yeah, thank you for commenting on that, and maybe I'll ask you just a last question to wrap up our conversation, and that is, where do you see yourself in, say, 5-10 years from now, in terms of your fund and also from a personal perspective?
Yeah, I kind of hope that not too different from where I am today. I really want to keep managing a fund. I want to keep investing in people's capital. I hope that it's going well enough that 5 years from now I still have capital. So
Yeah,
that's
otherwise it's just kingdom, no
yeah.
capital.
So yeah, I think that's my main focus. Like kind of you were saying earlier, my goal is to keep being present with my family and doing this and striking that balance. And yeah, I don't think there's a whole lot I hope to see change there. Hopefully, we can grow the fund, and I think aspirationally, I've thought about wanting to be more involved in some of the companies that we're invested in, whether it's in more of an active capacity or sitting on a board at some point. I also think that's something I want to take a really slow approach to. I don't want to I don't romanticize too much of getting into the weeds with guys that have been running a company for decades, and then me, the microcap fund manager, shows up and has lots of great ideas on how to run their business. Um, so I try to be thoughtful about if I'm going to suggest something to a company, that I've thought through it and feel good about it as a proposal. And up to this point, I've mostly just engaged more in the softer activism of just taking ideas to management teams and encouraging them, from a hi, I own 1% of your company perspective, stuff like that. But yeah, I think longer term, I'd like to get more involved. I think that's something that I want to be really thoughtful about. Jeff Graham has a really good book, Dear Mr. Chairman, where he talks about a lot of different examples of activism over the years and ways it's done well and ways it's done poorly. So I think reading that, part of it makes you want to go like fire off a bunch of letters to boards, and part of it makes you go, wow, that can really go badly. So
Yeah.
you covered the whole gamut of good and bad outcomes, and I think that's a good one for anyone who's thinking about how to engage with activism. Is some good examples in there, from Buffett to Icon to a lot of those big names, and some ones that you're probably less familiar with. So yeah, there's some pretty good reads, and I think that's something I'd like to pursue in the next 5 years, but do it thoughtfully.
Interesting. Excited to keep track of your moves and whether you end up becoming the next big activist investor.
Probably
So
won't be me.
yeah, not you don't want to become Bill Ackman.
I don't think so.
Okay, but yeah, probably just better being David Bastian.
Yeah, I think there becomes a level of notoriety that I would rather not deal with everything that comes with it. And
Right.
fortunately or unfortunately, I don't think I'm in danger of that anytime too soon.
Yeah, I guess also same for me. Like I really, even though I do stuff on the in the public sphere, yeah, I really don't want to be famous. So yeah, I feel you on that one. So yeah, it was really an interesting conversation. I hope the viewers and listeners also enjoyed it as much as I did. And I don't know, we could wrap it up here, but if you have any final words to add, or just telling the people that are watching this where they can find you and they can find your work and stuff, that would be
Yeah,
pretty awesome.
yeah. I'm active on Twitter, Kingdom Capital, or I think our handle is at Kingdom Cap ADV. KingdomCapitalAdvisors.com. We have all of our fund letters are posted there. I've got articles on Seeking Alpha going back a few years of different stuff I've covered. I spent some time in the microcap club community. So I'm around. Got a few things on Some Zero. So if you want to reach out, feel free. I'm always happy to talk ideas and swap thoughts with like-minded investors. And yeah, always looking for the next big winner here. Or if you have a great bear case on one of my stocks, definitely let me know before I lose money on it. So that would be great.
Yeah, that's awesome. So yeah, thank you so much for accepting this invitation. I really truly enjoyed this conversation. So thank you
Appreciate
so
it, David.
much.
Thanks for having me on.